Deep Dive with David Stendhal, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey, it's David Stendhal with tonight's Deep Dive. It is December 14, 2017, and I thought I'd take a look at wheat, with the ETF being WEAT. Now we've got the short, intermediate, and long-term trends all point to the downside. Any wheat trader has been seeing this for what seems to be an eternity, down, down, down with the trend. Same too with the seasonals. But we did have a slow low on the elastic level and a slow sub in our power level indicator that popped up today. So let's take a look at wheat in this particular case and get a feel for what's taking place. So this is a daily bar basis for wheat. You can see that we had the market pop up just a little bit here today. Nothing dramatic, but it's been putting in, if you can see in the value chart indicator, you can see that it had been slightly oversold and has been basing and headed higher. Now we've had both on the elastic level a little pivot here, which is an indication that the market is taking a rest, and that's probably the best way to look at wheat right now, because any wheat trader knows that the trend will probably continue to the downside, but we're taking a rest. That's what we'll refer to it. And the power level has also pointed to the same condition, where they're both having seen this little support level, and we'll see where the market's actually able to move from here. We also have in our energy level, it's very almost difficult to see. We've got two separate lines here, these yellow lines and the green in between. And the fact that the market has been in such a tight consolidation, not in the traditional sense, but in a volatility perspective, that the market is trending to the downside. It rests, it goes sideways, and so forth. But the volatility associated with the market has been extraordinarily low for an extended period of time, that we're starting to see signs of increased volatility in the market, which could bode well for the longs here. Now, as far as we're concerned, right now, the systems are short. We've got a 120-minute bar system that's short the market, and has been short since the December 4th, so it's got a nice little profit going, but nothing else really taking place here. So longer term, this is what I was referring to as the trend. You can see that the depth gauge here has been down, down, down. There's no doubt that it's in a bearish phase, but this is a longer term indicator, and it doesn't really coincide with the short term system. But I'm just simply pointing out that the tendency over the last 3 years has been bearish by nature. In fact, we obviously keep track of these things, and this only after the last 3 years, so it's not like we're looking back 10 years or so. But 64% of the time, CBOT wheat has been negative. Kansas City wheat's been a whopping 81%. If you look at all of the markets we track, both wheats are at the high end here. So there's no doubt that wheat traders have been experiencing and been watching over the short positions and the bear trend in wheat. When it comes to the seasonals, kind of a mixed bag here. This is the 5-year, if you can see my cursor here, which when we get into December, the beginning of December would be at the beginning of this phase going from the gray into the white, that you'll see that over the last 5 years, the seasonal tendencies have been negative through December. However, historically, once we get into middle of December, essentially where we are right now, the 10 and the 15 years are basically, they meander. They're not like they're strong, but they are not bearish by nature. They're more bullish to sideways. And so for all intents and purposes, you can make an argument that the market as a whole, specifically looking at the daily bars, that we could see a bit of a bounce if we're going to relate to the longer term seasonals, the 10 and the 15 years, and not be overly biased by what has been happening in the trends when I showed the 5-year seasonals and the the 3-year basis when it comes to the depth gauge, that they're definitely biased to the downside. But the fact is that we have had a couple of indicators or indicators that have shown us that the market is taking a little bit of a rest. The market could rally a little bit, maybe going up and approaching the 50-day moving average over the course of the next 4, 5, 6 days or so. And then when we get to that particular point, we'll see as whether or not the market's actually able to catch on fire and really start to take off, or is it going to get back into the malaise that we've seen in wheat over the last 3 years, where any type of a bounce is quickly shut off and we end up getting a sell-off once again. So we'll see how things do play out here, but for the time being, the systems are short. It's a 120-minute bar system. Again, let's just take a look at it here real quick. It's a swing base, so we could, conceivably hold on to this position for another day, maybe or so, maybe going into next week, and then we'll see what kind of true strength is there. And if the market reverses course, then we'll be fine with our shorts. Otherwise, we'll most likely be liquidating the position. So that's where we stand now for the time being, and we'll start to add some more content, some more charts here. That's the object over the next week or so, looking at some more patterns. Nothing has really popped up, but you can see that there's more information that's popping up in the deep dive. So we'll always look at a single market, but do watch over the deep dive because there's a lot of valuable information in there. Thanks for watching, and we'll look at another market tomorrow.